Okay, let's unpack this. We've got quite a stack of sources here, reports full of data, articles really drilling down into the financial nuts and bolts of real estate. And honestly, some numbers in here about the U.S. rental market right now are, well, they make you pause.
They really do.
Do you see this stat? Last year, 85% of landlords raised rents, which sounds great for them, right?
I think so.
But get this, 26%, that's over a quarter, saw their operating costs jump by more than 20%.
Yeah, that's a huge jump, not just a little bump.
Exactly. It's not a minor fluctuation. That's a serious, serious squeeze on profitability.
It absolutely is. It's so easy to just look at headlines. Rents are going up, landlord must be making a killing.
Yeah.
But the reality, like that Baseline 2025 survey shows, it's just much more complex. Understanding if a property is really making money in this kind of environment, it goes way, way beyond just looking at the rent coming in.
And that complexity, that's exactly why we're doing this deep dive today. We're focusing laser sharp on analyzing U.S. rental property cash flow.
Good.
Yeah.
It's essential.
We really want to help you, the listener, cut through all that noise, understand what the numbers are truly telling you, and, learn how to measure and manage the financial health of your rentals effectively.
And we've pulled from quite a range, haven't we? There are those market reports like Baseline with all the latest trends and costs, but also detailed articles on the financial analysis itself, stuff from like Data Semantics, Ledger Labs. They explain the right ways to track things, the accounting side.
And crucially, the mistakes people make.
Yes, crucially, highlighting those common mistakes that can, frankly, turn what looks like a great investment completely upside down.
So think of this deep dive as your personal guide, your shortcut to understanding the real financial engine of a rental property.
That's a good way to put it.
Our goal, our mission here is for you to walk away knowing what cash flow actually means for rentals, how to forecast it, track it accurately, identify the big factors pulling those levers, and importantly, how to avoid the pitfalls that are tripping up other investors. Right.
Ultimately, it's about helping you make smarter, more profitable decisions in this, well, pretty dynamic market we're seeing.
It really is about shifting from just hoping your property is profitable to knowing it is and having the data, the numbers, to back that up.
Okay, so let's start right at the beginning, the absolute basics. What exactly is cash flow when we're talking about real estate?
Right. So at simplest level, cash flow is just money moving.
Okay.
Cash coming in versus cash going out. Ledger Labs defines it broadly, the net cash flow of any business. For a rental property, that translates very directly. It's the money you get, mostly rent, compared to all the money you spend on that property.
So income minus expenses. Simple.
Simple concept, exactly. But the result of that simple math is, well, it's everything. If your income is actually more than your expenses, you've got positive cash flow.
That's the goal.
That's absolutely the goal. It means the property is profitable, like on a recurring basis. It's generating extra cash after covering all its own costs.
And that positive cash, it's not just, bonus money. It's vital. You need it to build up reserves for future repairs, cover unexpected things that always pop up, or maybe even fund your own lifestyle or pour into other investments.
And the flip side, negative cash flow.
Yeah, that's when your expenses are higher than your income. Plain and simple, you're losing money on that property each month or each year.
Ouch.
Yeah. It could be because of long vacancies, maybe a huge repair you weren't ready for, or just consistently high operating costs that the rent doesn't cover.
Right.
It means you're actually having to put your own money in just to keep the property going. Obviously, that's a situation you really need to understand and ideally avoid.
Okay, positive versus negative, that's clear. But why is forecasting it so critical? The sources really hammered this point. Why not just, watch the bank account, pay bills as they come?
That's a great question, and Data Semantics makes a really compelling case here. Accurate cash flow forecasting, it's not just about looking back at what happened. It's a crucial tool for making smart decisions about the property going forward. Should you even buy this place?
Right.
Can you actually afford to keep it if, say, interest rates go up? Can you handle that big renovation you're thinking about? Forecasting gives you the data to answer those kinds of critical questions before you commit.
So it's really about planning, preparing for what's coming.
Absolutely. It lets you anticipate future expenses, both the regular stuff, the operating costs, and those bigger, less frequent hits.
Like a new roof or something.
Exactly. And maybe more importantly, it helps you predict potential cash shortfalls way ahead of time. If you know a JIT might be coming 6 months down the road,
You can brace for it.
you can brace for it. You have time to build up reserves or maybe make some strategic changes to avoid it.
Does it also help spot ways to maybe boost income or cut costs?
Yeah, data semantics points that out too. By laying out all the expected income and all the expected expenses, you can clearly see where the big levers are. It helps you identify opportunities to maximize your profit. Maybe it's adjusting rents, maybe finding ways to be more efficient with spending, maybe focusing on keeping tenants longer to minimize vacancy.
I also noticed it seems almost essential if you need financing, if you're dealing with lenders.
Absolutely critical,
Yeah.
non-negotiable almost. Data semantics and the Ledger Labs FAQs both really stress this. Accurate cash flow projections. They're essential for getting a loan.
Why is that?
Lenders need to feel confident that the property itself will generate enough income to comfortably cover that mortgage payment.
Right.
Your forecast is your proof. It demonstrates the property's ability, its potential to actually repay the debt. Without it, it's much harder to get financing.
Okay, so forecasting is like looking into the financial crystal ball, but, based on data to make smarter choices now and down the line. What are the absolute must-haves in that forecast? What components do you need?
Data semantics and Ledger Labs break it down pretty clearly. First, obviously, you need to forecast your income.
Okay. The rent.
Primarily the rent, yes, your projected rental income. But don't forget other potential revenue. Things like late fees, maybe pet fees, laundry machines, parking spots.
Anything else the property brings in?
Exactly. You need to be realistic about how much you can genuinely expect to collect from all sources.
Okay. Income covered. Then the other side.
Right, the expenses,
Yeah.
the money going out, these are your ongoing operating costs.
Like what specifically?
Maintenance, repairs, the regular upkeep stuff,
Yeah.
property taxes, insurance premiums,
Yeah.
utility costs if you're the one paying them,
Mm-hmm.
property management fees if you use a manager, marketing costs when you need a new tenant.
Mm-hmm.
Forecasting these accurately. That's off of the trickiest part, especially now with costs being so volatile.
Yeah, we saw those numbers earlier. And there's one more key piece that hits the income side, right?
Yes. Vacancy and tenant turnover rates. Data semantics is really clear.
Yeah.
You absolutely cannot ignore this. It's tempting to assume 100% occupancy, but
Not realistic.
not realistic at all. When a unit's empty, your income from it is zero. Zip. And tenant turnover itself costs money. You've got cleaning, maybe some painting, advertising for a new tenant, screening them, all while potentially losing rent during that gap.
So you need to build that potential downtime into your forecast.
You have to. Factor in realistic assumptions for how often and for how long your units might sit empty based on your market.
Okay. Income, expenses, vacancy. Conceptually, it seems pretty straightforward. But investors, they use a whole bunch of specific terms, specific metrics, right? It goes beyond just income minus expenses.
Oh, yeah, definitely. These metrics, they give you deeper insights into different aspects of a property's financial performance.
And they'll let you compare different deals.
Exactly. They help you compare different opportunities on more of an apples-to-apples basis.
Mm-hmm.
So yeah, let's dig into the big ones.
Okay, first up, net operating income, NOI. The sources called this the property's true engine room, its core financial performance.
That's a really good description. NOI, like maximizing rental property cash flow, Ledger Labs, and Stessa, all define it.
Yeah.
You're calculated by taking the property's total income.
Right.
And subtracting its total operating expenses. But, and this is the crucial part, it's before you account for three really big things.
Okay, what are they?
Debt service, that's your mortgage payment. Principal and interest. Capital expenditures, or CapEx, it's those major infrequent repairs or improvements, and depreciation, which is a non-cash deduction for tax purposes.
So NOI is just the income generated purely from the day-to-day running of the property itself.
Precisely. The formula is simple. Gross rental income, after adjusting for vacancy and bad debt, minus total operating expenses. That's your NOI.
Oh, okay, but why calculate it before the mortgage? I mean, the mortgage payment is a huge part of my actual cash flow, isn't it?
It absolutely impacts your personal bottom line, your actual cash in pocket, but NOI serves a slightly different, really important purpose.
Which is?
As Ledger Labs FAQs and maximizing rental property cash flow explain, NOI shows the property's fundamental profitability just from its operations. It's independent of how you decided to finance it. Think about it. Two identical houses, side by side, same rent, same operating costs like taxes, insurance, maintenance. They will have the exact same NOI.
Right, makes sense.
But maybe owner A paid all cash and owner B has a 90% mortgage, the actual cash flow after the mortgage payment will be wildly different.
Okay, I see.
So NOI lets you compare the operational effectiveness and the income potential of the property itself, stripping away the owner's financing choices. It levels the playing field for comparison.
That makes a lot of sense. It's an unlevered view. So let's get specific about those operating expenses that get subtracted. What's included?
Stessa gives a really good breakdown, and it lines up with what data semantics and ledger labs say. You definitely include things like marketing costs to find tenants, tenant screening fees, any leasing commissions you pay.
Okay.
Property management fees. Stessa points out these often run around 8% of the rent collected, which is a common benchmark.
So costs to get it rented and keep it managed?
Yeah.
What else?
Then you've got the ongoing running costs of the property itself. Routine repairs and maintenance, just the everyday upkeep. Landscaping, snow removal if that applies, pest control, utilities but only if the landlord pays them, property insurance premiums, the annual property taxes, and any HOA fees if it's in a homeowners association.
Okay.
Stessa even makes a practical suggestion. Use your IRS Schedule E form, that's one for rental income and expenses, as a pretty good checklist for what typically counts as an operating expense.
That's a handy tip. Now, what's definitely not included in operating expenses for NOI?
Stessa is very clear here. The biggest exclusion is the mortgage payment principal and interest. That's debt service, and it depends entirely on the owner's financing deal.
Right, we established that. What else?
Capital expenditures, CapEx. These are the big ticket items. A new roof, replacing the whole HVAC system, a major kitchen renovation.
Things that add long-term value or extend the life.
Exactly. They're not routine upkeep. They're major improvements or replacements. So they're excluded from OPEX for NOI calculation.
Okay, so operating expenses are the regular recurring costs to keep it running day to day. CapEx are the big, infrequent, value-adding jobs.
You got it. Also excluded from NOI are the investor's personal income taxes, totally dependent on their overall situation, and depreciation. Depreciation is a valuable tax deduction, but it's non-cash. Money isn't actually leaving your account. Stessa mentions that 50% rule, estimating operating expenses as roughly half the gross rent, excluding mortgage and CapEx, but they really stress it's just a very rough rule of thumb. You need detailed, specific forecasting for your property. Don't rely on that rule for actual decisions.
Got it. So NOI, property's operational profit before financing and big capital costs.
Yep.
What's the next key metric people talk about? Cap rate.
Yep, the capitalization rate, or cap rate. Maximizing rental property cash flow defines it pretty simply. It's the property's net operating income, NOI, divided by its current market value, or what you paid for it, the acquisition cost.
So formula is cap rate equals NOI price. I remember the Reddit source you shared had a lot of discussion, maybe even some debate about this one.
It did. And that discussion is actually really useful because it highlights a common point of confusion. Cap rate is primarily used as a valuation metric.
Valuation, how so?
Investors, appraisers, they use it to compare the relative value of different income-producing properties within a specific market. It also helps estimate a property's value based on the income it generates. You can flip the formula. Value equals income, NOI, divided by the rate, cap rate.
Okay. But that Reddit thread seemed pretty emphatic that the cap rate is not my personal return on investment if I used a mortgage, right?
This is the absolute key takeaway from that discussion, and where a lot of new investors get tripped up. Cap rate uses unlevered income, the NOI, which, as we said, ignores your mortgage.
Right.
So if you buy a property advertised with, say, a 7% cap rate, that does not automatically mean you are getting a 7% return on the actual cash you put into the deal if you have a loan.
What?
Because your loan payments eat into that NOI before you see any cash. The Reddit users debated the nuances, but the consensus among the experienced folks was clear. While a higher cap rate might suggest higher potential returns, it often signals higher perceived risk, maybe a less desirable location, or more management intensity needed. It's a tool to compare the property's operational income relative to its price in the market, not a direct measure of your personal cash return on a leveraged investment.
Okay, that distinction is critical. Cap rate for market comparison based on operations, independent of financing. If that's not my personal return, what metric tells me that?
That's where cash-on-cash return, often called COC return, comes in. Both maximizing rental property cash flow and those Reddit threads define this clearly. It's the property's annual cash flow after you've paid the mortgage after debt service, divided by the actual amount of cash you personally invested in the deal.
The cash I had to bring to closing, like the down payment, closing costs, maybe money for initial repairs I paid out of pocket.
Exactly that. That's your equity invested or cash invested. So the calculation is simple. Annual cash flow after debt service, total cash invested.
And why is this one so important for someone like me, an individual investor?
Because it directly measures the return you're getting on the actual money you took out of your pocket and tied up in this specific property. For most investors who use financing, which is the vast majority, this is often the number they're really thinking about when they talk about their return.
So it's personalized to my situation.
Completely. Unlike cap rate, cash on cash does account for your specific loan structure. It gives you a true picture of how effectively your invested capital is performing in that deal.
Makes sense.
And as the Reddit thread also noted, your cash on cash return isn't static. It can change year to year as your income or expenses fluctuate, or maybe if your loan payment changes, like with an adjustable rate mortgage. Those are maybe less common for typical investment properties these days.
Okay, so cap rate compares the property's core performance in the market. Cash on cash shows the return on my invested dollars in this deal with my financing. Got it. What about the lenders? What's their favorite metric?
For the lenders, it's usually the debt service coverage ratio, or DSCR.
DSCR.
Maximizing rental property cash flow defines this as the property's net operating income, NOI, divided by its total annual debt service. This is the sum of all the principal and interest payments on the mortgage over a full year.
So DSCR equals NOI, annual mortgage payments. Why do lenders love this one so much?
Because, as both the Ledger Labs FAQs and that sample pro forma guide we looked at show, it's their primary tool for assessing risk. It tells them if the property itself is generating enough income from operations to cover the mortgage payment comfortably.
Comfortably? What does that mean?
Well, a DSCR of exactly 1.0 means the NOI is just enough to cover the debt payment with nothing left over. Lenders don't like that. It's too risky. No buffer at all. They typically want to see a DSCR of 1.2 or maybe even higher, like 1.25. This means the property's NOI needs to be at least 20–25% greater than the annual mortgage payments. That extra cushion gives them confidence that even if vacancy ticks up or expenses rise unexpectedly, there's still enough cash flow to make the loan payments.
That buffer makes perfect sense from their perspective. Okay, any other quick metrics worth mentioning before we move on?
Yeah, one more quick one is the gross rent multiplier, or GRM. Maximizing rental property cash flow explains this is just the property's purchase price divided by its annual gross rental income. That's income before factoring in any expenses or vacancy.
GRM exalts purchase price gross annual rent. Sounds super simple to calculate.
It is. Very quick, very simple. It's used as a really basic initial screening tool. You might look at the GRM for several properties in an area just to get a rough sense of how prices compare relative to rents.
So lower is maybe better?
Potentially. A lower GRM might suggest a property is priced more attractively based on its raw income potential. But it completely ignores all operating costs. A property could have a low GRM but sky-high expenses, making it a terrible investment.
So useful for a quick first glance maybe, but definitely not for making a final decision.
Exactly. You'd never rely on GRM alone. It tells you nothing about actual profitability or cash flow after expenses are paid.
All right, that's a great breakdown of the core concepts and metrics. We know what cash flow is, how to measure it with things like NOI, cap rate, cash on cash, DSCR. Now, let's talk about what actually moves those numbers. What are the forces pulling these cash flow levers? You said the market feels really dynamic right now.
Incredibly dynamic. There are so many factors, both external market forces and internal property specifics, that constantly influence a property's cash flow. It's never static.
Okay, let's start with the most obvious one, rent. What the market will bear, market conditions.
It's absolutely fundamental. Maximizing rental property cash flow points out that broad economic conditions play a big role. A strong economy often supports rent growth, while a downturn might mean higher vacancy, maybe pressure to lower rents. But crucially, it's the prevailing rental rates in your specific local market that matter most for your property. National trends are one thing, your neighborhood is another.
And that Baseline 2025 report had some really striking recent data on rents, didn't it?
It really did. It confirms that strong upward trend we've seen. Remember, 85% of landlords raised rents in 2024.
Right.
And 78% are planning more increases in 2025 with a projected average hike of over 6%. That's significant.
And the report mentions Zillow data showing median rent for a two-bedroom hit over $1,900 last year.
Yep, $1,906 median for a two-bedroom in 2024. That was up 3.2% from the year before. But the really staggering number is the 5-year picture. A 32% increase nationally over just 5 years.
Wow. a third higher in 5 years.
That's a lot. Huh?
But you mentioned the baseline report also talked about big regional differences. It's not one single U.S. market picture, is it?
Not at all. And this is a critical insight for anyone forecasting their own cash flow. National averages are just averages. The real story for your income potential is hyperlocal.
So what did the report show regionally?
Well, using Zumper data, Baseline pointed out that areas where housing supply is still tight and population growth is strong. Think many cities in the Midwest and the Northeast, like New York or Detroit. They're just still seeing pretty solid rent increases. Demand is high there.
Okay. While other places might be slowing down.
Exactly. In parts of the Sun Belt and the Intermountain West, places like Phoenix, Austin, where there's been maybe more new construction, especially single-family homes, some of those markets actually saw slight rent declines, or landlords needing to offer concessions like a free month's rent.
So more supply means more competition, less pricing power.
Precisely. Landlords there face a different income calculation. And then there was that surprising finding about smaller cities, smaller metros.
Yeah, what's that?
Places you might not immediately think of, like Oxford, Mississippi, up 25% in rent in 2024, according to Zillow data in the report. Athens, Ohio, up 21%. Mount Pleasant, Michigan, up 17%.
Wow. Why such big jumps there?
Baseline suggests these could be emerging investor hotspots. The initial purchase price, the cost to get in, is often much lower than in the big coastal cities or major metros.
Right.
So even with slightly lower rents than, say, New York, the yield, the return relative to the investment cost, can potentially be much higher.
Interesting. So the big takeaway for forecasting income is ignore national averages, focus intensely on your local supply, demand, and economic trends.
Absolutely. And don't forget property-specific factors, as data semantics and maximizing rental property cash flow mentioned. Location within the market matters hugely, and the condition and features of your specific property, updated kitchen, nice bathroom, good curb appeal, those allow you to command higher rents within that local market.
Okay, so local market dynamics, property features drive the income side. But then there's the other side of the coin, expenses. You called them soaring based on the baseline report.
They really are. But if you don't manage them carefully and forecast them accurately, they can just silently eat away at your cash flow.
Yeah.
We listed the usual suspects earlier: property taxes, insurance, maintenance, utilities, management fees based on data semantics, Ledger Lab, Stessa.
Right. But the size of the increases in that baseline data was what really jumped out. 82% of landlords saw costs go up in 2024.
82%. That's almost everyone.
And for 26%, over a quarter of them, costs jumped by more than 20% in 1 year. That's not inflation. That's a gut punch to profitability.
It's brutal. And the survey pinpointed the main drivers. What were landlords blaming? Property taxes were number one, cited by 60%.
Okay, that makes sense if values went up.
Right. Then maintenance and repair costs, 57% cited those. Utilities, 49%. And insurance premiums, 43%. Those four, the big ones hitting hardest.
Maintenance costs cited by almost 60%. And the report mentioned Thumbtack data suggesting average single-family home maintenance is over $10,000 a year now. That seems incredibly high.
It is a significant figure, and it really underscores how important it is to budget realistically for maintenance. You can't just cross your fingers and hope nothing breaks. That $10K average covers everything from minor repairs to maybe bigger system upkeep, but it shows that ongoing costs are substantial.
And besides those operating costs, financing costs matter too, right?
Absolutely. Especially for your cash flow after debt service. Your mortgage interest rate, the loan terms, they directly determine that monthly payment. Baseline did suggest we might see some easing of mortgage rates in 2025, which could help a bit.
We'll see.
We'll see. But rates right now are still much higher than they were a few years ago, and that impacts affordability for buyers, which keeps rental demand high, but it also impacts the cost of financing for investors and the DSCR they need to hit.
Okay, so rising costs are a huge factor. Let's shift back to the income side for a moment. Vacancy and tenant turnover. How much does that impact things?
It's critical, as data semantics pointed out. Every day a unit sits empty, you're losing income, period. And turnover isn't free either. There are direct costs: cleaning, painting, marketing, screening new applicants. And indirect costs, the lost rent, during the time it takes to get it ready and find someone new.
What did the baseline report say about current vacancy rates nationally?
It cited Census Bureau data showing the national rental vacancy rate was 6.9% in the third quarter of 2024. That was up just slightly from 6.6% at the end of 2023.
So nearly 7% vacant nationally. That's not insignificant.
No, it's not. And even though overall demand is still strong enough in most places to keep rents relatively high despite that rate, it's a real number. It means on average, units are empty about 7% of the time. You have to build that vacancy factor into your cash flow projections. You can't assume zero vacancy.
Ledger Labs even showed how to calculate it for your own property if you track the empty weeks.
Yeah, their example was stark. If your unit was vacant for 16 weeks in a year, maybe between tenants, maybe longer, that's over a 30% vacancy rate for your specific property that year. You need to be honest with yourself about potential downtime.
Okay. We also touched on capital expenditures, CapEx, when we talked about NOI. They're not operating expenses, but they still loom large.
They loom very large. Data Semantics lists the classics: new roof, new HVAC, plumbing overhaul, major appliance replacements, significant renovations.
The big stuff.
The big, expensive stuff. If you don't anticipate these and budget for them over time, when one inevitably hits, it can create a massive, unexpected cash shortfall that could wipe out years of your positive cash flow in one go.
So separate from OPEX, but needs its own savings plan.
Exactly. As Tessa clarified, they're different categories, but CapEx requires setting aside reserves systematically.
This leads to another challenge that the Base Lane report really focused on, something becoming more and more complex: all the laws and regulations around tenants.
This is definitely a growing headache for landlords. Base Lane survey found 17% of landlords said just complying with local and state rules was a significant challenge for them last year.
And the trend is towards more rules.
Yes, there is a clear trend across the country towards increased tenant protections, and in some places, various forms of rent control or rent stabilization, often driven by concerns about housing affordability.
Did the sources give specific examples?
Yeah, Base Lane mentioned California's statewide cap. I think it's 5% plus local inflation, up to a max of 10% annual increase. And Oregon has a statewide cap, currently 7% plus inflation, I believe. These directly limit how much a landlord can raise rent.
Which directly hits the income side of cash flow.
Directly. Especially if your own costs, property taxes, insurance, maintenance, are rising faster than that allowed rent increase. Your margins get squeezed even tighter.
How else do these regulations impact landlords and their cash flow?
Well, Base Lane explains it can reduce overall profitability, which might make landlords less able or less willing to reinvest in upgrades or even necessary maintenance.
Because the money's not there or the return isn't worth it.
Exactly. If you can't raise rents enough to cover rising costs and generate a return, you might end up deferring maintenance, which isn't good long term. Plus, just navigating these rules, they're often complex, they vary city by city, state by state, and they change. It often means needing legal advice, which adds another operating cost.
So more compliance costs.
Right. Landlords are constantly weighing the cost and hassle of strict compliance against the potential risks and costs of getting into legal disputes with tenants if they misstep. It adds another layer of complexity and risk to manage.
So keeping up with local laws is now just as vital as tracking market rents or repair costs.
It absolutely is. And one last factor here, just the overall efficiency of your property management.
How you run the place day to day.
Yeah. Maximizing rental property cash flow points out that good, efficient management helps minimize those vacancy periods through smart marketing and careful tenant screening. It can help reduce operating expenses by having good relationships with reliable, fairly priced contractors, and it optimizes income by ensuring rent is collected on time and encouraging good tenants to renew their leases. Whether you do it yourself or hire a pro, the quality of management directly impacts cash flow.
Okay, wow. That's a lot of factors influencing cash flow: market rents, soaring expenses, vacancy, CapEx, regulations, management. It's a complex picture.
It really is.
Now, given all that complexity, let's talk about where people go wrong. What are the common mistakes that just sink cash flow? Data Semantics laid out 4 big forecasting pitfalls.
Yeah, and these are so important to understand because making these mistakes leads directly to bad projections, which leads to nasty surprises down the road.
Okay, mistake number 1 they listed: overestimating rental income.
This is classic wishful thinking. An investor gets excited. Maybe they look at the highest rent advertised for a similar unit down the street or just assume they'll get top dollar, and they plug that number into their spreadsheet without really questioning it.
But reality might be different.
Reality often is different. Data Semantics reminds us you have to realistically consider all those factors we just talked about: the specific location, the level of competition, current market conditions, are things hot or cooling, and the actual features and condition of your property compared to others.
So how do you avoid being overly optimistic?
Research. Data semantics advises looking at actual listings for comparable rentals, right in your immediate area. Talk to local agents who know the market intimately. Maybe even go check out some competing rentals yourself.
See what they really offer.
See what they offer, what condition they're in, what they're actually renting for. Consider the local economy. Is job growth strong or weak? Factor in any renovations you plan that genuinely will support a higher rent. And then, crucially, be conservative in your final estimate. Always build in a buffer for vacancy, and maybe even anticipate periods where you might need to offer a small concession or slightly lower rent just to get a good tenant in quickly if the market softens.
Okay, be realistic, be conservative on income. Mistake number 2, underestimating operating expenses. Given what we heard from Baselane about soaring costs, this feels particularly dangerous right now.
It absolutely is. This is probably where most projections fall apart. Data semantics explains it happens when investors just don't budget realistically for all those fluctuating costs, taxes, insurance, maintenance, utilities, management, marketing, you name it.
Especially with 82% seeing costs rise and 26% seeing jumps over 20% last year. Just using old numbers or a rough guess like that 50% rule seems like asking for trouble.
It's a recipe for disaster.
Yeah.
It really highlights why you need to get granular with expense forecasting.
Yeah.
Data semantics suggests researching typical operating costs for similar properties in your specific area. Don't assume national averages apply. Factor in any planned upgrades that might actually increase costs. Maybe adding central air will bump up electricity use. And maybe the most important tip, include contingencies in your budget. Set aside funds for unexpected repairs or sudden spikes in things like insurance premiums or property taxes. And once you own it, track your actual expenses like a hawk against your budget so you can spot problems early.
Okay, budget realistically for expenses, include a buffer. Mistake number 3, ignoring vacancy rates and tenant turnover.
Another huge oversight. It directly hits your income and increases your costs. Data semantics is blunt. Projecting 100% occupancy 100% of the time is just not realistic. Doing so means you're overstating your income from day one.
And ignoring turnover costs, too.
Right. Forgetting to budget for the cleaning, painting, advertising, screening, and lost rent between tenants means you're not accounting for real expenses that absolutely will occur.
We saw the national vacancy rate is near 7%. You just have to assume some downtime.
You have to factor it in. Data semantics also suggests ways to minimize vacancy and turnover, which helps your cash flow indirectly. Things like careful tenant screening up front to find reliable people less likely to leave early or cause problems.
Okay.
Maintaining good communication with your tenants. Responding quickly to maintenance requests that keeps tenants happy and protects your asset. And maybe offering small incentives for lease renewals to keep good tenants in place longer.
Makes sense. Okay, final one, mistake number 4. Failing to account for capital expenditures. CapEx.
This is where the really big unexpected financial hits often come from. Data semantics lists those major items again: roofs, HVAC systems, plumbing replacements, big renovations. If you haven't been putting money aside specifically for these,
You're in trouble when they happen.
you're in big trouble. You face a massive cash crunch that can derail your whole investment.
And these aren't covered by your regular operating expense budget, right?
Correct, as Tessa noted. They're separate. But data semantics emphasizes they must be budgeted for separately over the long term. How? Conduct regular, thorough inspections of your property to spot potential big-ticket issues early. Estimate the remaining lifespan of major components: roof, furnace, water heater. Estimate the future replacement costs and build that into your long-range forecast.
And the key is actually saving the money.
The crucial step is setting aside reserves regularly. Create a separate savings account, a sinking fund, specifically for future CapEx. Treat it like another necessary operating cost, even though it's technically different. It's essential for the long-term financial health of the property.
Okay, avoiding those 4 mistakes, overestimating income, underestimating expenses, ignoring vacancy, forgetting CapEx seems absolutely vital. But investing isn't just about avoiding mistakes, right? It's also about actively trying to improve things. What strategies do the sources suggest for maximizing cash flow?
Yeah, exactly. Analysis is step 1, action is step 2. Ledger Labs and Maximizing Rental Property Cash Flow offer several strategies focused on boosting the income side.
Like what?
Well, implementing strategic rent increases whenever the market and local regulations allow. Don't just let rent stagnate if the market has moved up. Conduct regular market research to make sure your rents are competitive, but also not leaving money on the table. Work hard to minimize those vacancy periods, good marketing, efficient screening, maybe quick turnovers, and look for opportunities to add other income streams. maybe charging for pets, offering premium parking or storage, adding coin-op laundry if feasible. Little things can add up.
Okay, boosting income. What about the other side, pushing expenses down?
There are definitely ways to control costs. Prioritizing routine maintenance is huge, according to maximizing rental property cash flow. Fixing small leaks before they cause major water damage, servicing the HVAC regularly to prevent breakdowns. Preventative care saves money long-term.
Makes sense.
Negotiate rates with your service providers, get multiple quotes for insurance, talk to your landscaper or handyman about package deals. Don't be afraid to shop around. Consider investing in energy-efficient upgrades, better insulation, LED lighting, efficient appliances. This can lower utility costs, which might benefit you or your tenant, making the unit more attractive. And as Baselane noted with the sustainability trend, there might even be tax credits or rebates available for these kinds of upgrades.
Good point. Any other expense tips?
Well, you could consider self-managing if you genuinely have the time, skills, and temperament for it. That eliminates the property management fee, which can be significant.
But comes with its own costs and time and hassle.
Absolutely, it's a trade-off. And finally, leverage technology. Use software or apps to automate administrative tasks like rent collection, bookkeeping, communication. That can save time and potentially reduce overhead costs.
That tech piece seems increasingly important. But before we dive deeper into tech and management, how often should investors be doing this kind of cash flow analysis? Is it a one-time thing when you buy?
Definitely not. Ledger Labs and APM both really emphasize the need for regular, consistent analysis.
How regular?
Ideally, you should be looking at your cash flow monthly, or at least quarterly, and doing a thorough review annually. This isn't something you just set and forget.
Why is ongoing analysis so important?
Because it gives you real-time insights into how your property is actually performing compared to your initial projections. Markets change, costs fluctuate. Regular analysis helps you pinpoint exactly where things might be going off track or where opportunities are emerging.
So it helps you adjust your strategy.
Precisely. It tells you where you might need to focus on increasing income or where you need to clamp down on expenses. And it provides the hard data you need to make those bigger strategic decisions. Is it time to refinance? Should I invest more in upgrades? Or maybe, is it time to sell this property? Consistent analysis informs all of those choices.
Okay, so regular analysis is key. Now let's circle back to that technology angle and also the question of professional management versus DIY. The Baselane report suggested a lot is changing fast here.
It really is. Technology adoption is accelerating and becoming a real differentiator in managing properties efficiently. Baselane cited that striking stat. 93% of property managers said they adopted some form of new tech in just the last 18 months.
Wow. What kind of tech are they adopting?
The most common things mentioned, based on NAA data in the report, were using social media for marketing rentals, about 12.5%, and implementing tenant portals for communication and payments, about 12.3%.
And you mentioned AI is starting to make inroads, too.
Yeah, it's moving beyond just hype. Baselane gave the example of Elise AI, which uses conversational AI like chatbots to handle things like initial leasing inquiries, scheduling tours, answering common questions. Apparently, it's powering interactions for a significant chunk of multifamily units already.
Interesting.
And their survey showed nearly half of property management pros are either using AI now or plan to start soon. It's definitely a trend to watch.
How is tech changing something basic like just collecting the rent?
It's making it much faster, more reliable, and often preferred by tenants. Baselane's survey showed this shift clearly. While traditional methods like paper checks, still used by 56%, and cash, 53%, haven't vanished, especially maybe with smaller landlords.
Digital is catching up fast.
Very fast. 49% are now using P2P apps, think Zelle, Venmo, PayPal. 45% use ACH direct deposit. And 27% use dedicated online property management platforms that handle payments. And other data mentioned in related articles suggests nearly half of renters actually prefer to pay online now.
So tech helps automate tasks, saves time, smooths out payments, gives you better data for analysis. What's holding some landlords back from jumping in?
The biggest barrier cited in the Baselane survey by 35% of landlords was the cost of implementation. Getting started with new software or systems can seem expensive.
Right.
So there's definitely a need for affordable, user-friendly solutions, especially for smaller independent landlords. But reports like Baselane's try to make the case that often the investment in tech pays off pretty quickly through time savings, fewer errors, and more reliable cash flow.
Okay, so tech is a big piece. What about the human element? The fundamental decision. Manage all this yourself? or hire professional help, like an accountant or property manager.
APM had a good discussion on this DIY versus pro decision. Going it alone, managing your own books and the property itself, it can work, especially if you only have one or two properties. You're highly organized, you enjoy the process, and you have the time to dedicate to it. Being a seasoned landlord helps too.
But there are definite advantages to bringing in pros.
Absolutely. Professionals, whether it's an accountant focused just on the finances or a full-service property management company, they primarily save you time. Lots of time. They can also help reduce errors in bookkeeping or compliance. They stay on top of complex regulations, tax laws, local tenant ordinances, which can be a huge burden, and they just handle the sheer volume of work involved.
Can hiring a manager actually pay for itself?
That APM pro tip made a great point about this. A good property manager might actually offset their fee or even increase your net profit. How? By minimizing vacancy through better marketing and screening, ensuring more consistent rent collection, making sure you're taking all legitimate tax deductions, potentially negotiating better rates with vendors because of their volume.
And freeing up your time.
And freeing up your time to maybe find the next deal or focus on other things. So it's a cost-benefit analysis. And whether you DIY or hire pros, technology tools, good software, even well-organized spreadsheets are essential support for either approach.
Okay, we've covered a ton of ground, the concepts, the metrics, the factors, mistakes, strategies, tech. Let's try to make it really concrete now. You shared that sample single-family rental pro forma from eCode 360. Can we walk through that as an example? This is the kind of forecasting tool people actually use, right?
Absolutely. This kind of pro forma spreadsheet is standard practice for projecting a property's potential financial performance over time. It's how you forecast that cash flow we've been talking about.
Okay.
Let's look at the Operating Pro Forma tab first. That's where we calculate the NOI before debt.
Okay, using the sample numbers they provided, how does it start?
It starts with gross rent. The sample uses a hypothetical single 3-bedroom unit, and based on market comps, they estimate it could rent for $650 a month. Annually, that's $7,800.
But we know we can't just assume we'll collect all $7,800, right?
Right.
Mistake #1.
Exactly. So the next crucial step is factoring in vacancy and potential bad debt, rent you just never collect. The sample conservatively deducts 5% for vacancy, $390, and 2% for bad debt, $156.
Okay.
Subtracting those from the gross rent gives you more realistic gross effective income. In the sample for year one, that's $7,254.
Got it. Realistic income estimate. Now, what about the expenses shown in the sample?
It breaks down the projected annual operating expenses into standard categories. Things like administrative costs, $950 in the sample,
Right.
maybe some payroll, if applicable, $797, maintenance, $805, other operating costs like utilities, maybe $330, and then taxes and insurance, $730.
Okay.
Adding all those up gives the total annual operating expenses. For year one in this sample, it's $3,612.
Right. So now we take that gross effective income, $7,254, and subtract the total operating expenses, $3,612. What does that give?
That gives us our net operating income, NOI, before reserves and debt service. In the sample calculation, $7,254 minus $3,612 equals $3,642 for year one. That's the cash the property's operations generated before setting aside money for future big repairs and before paying the mortgage.
And you mentioned setting aside money reserves. The sample includes that too.
Yes, and it's critical. The sample budget's $500 per year for replacement reserves. That's for the eventual roof replacement, HVAC, etc. And it adds another $80 for operating reserves, just a small buffer for unexpected monthly shortfalls. So total annual reserves in the sample are $580.
Okay, so we take the NOI, $3,642, and subtract those reserves, $580.
Correct. That gives you cash flow before debt service. $3,642 minus $580 equals $3,062 in year one. This $3,062 is the cash available from operations, and after setting aside reserves, that can be used to pay the mortgage.
And the sample shows the debt service, the annual mortgage payment, principal and interest, as $2,551.48 per year. Where does that number come from?
Good question. In this pro forma guide, that number actually comes from a separate calculation called supportable debt. Essentially, the lender looks at the property's NOI, $3,642, and their required DSCR, 1.2 in this sample, and calculates the maximum loan amount the property's income can safely support. The $2,551.48 is the annual payment on that calculated loan amount.
Okay. So the property's performance dictates the loan payment shown and the final number, the actual cash flow.
That's the cash flow after debt service. It's the bottom line for the owner. What's left after paying all operating expenses, setting aside reserves, and paying the mortgage in the sample. $3,062 cash flow before debt minus $2,551.48. Debt service leaves $510.52 in actual positive cash flow for the owner in year one.
Okay, $510 a year. Honestly, that doesn't sound like a huge amount for the first year.
It might not seem like much initially, but this is where the long-term view of the pro forma becomes really important. There's usually another tab, like the 20-year cash flow projection shown in this sample.
What does that show?
It projects the potential performance over the entire loan term, typically 20 or 30 years. And critically, it incorporates adjusters or escalators. These are assumptions about how income and expenses might change year after year.
Like inflation.
Exactly. The sample assumes income, rent, will increase by 2.25% per year, but assumes expenses will increase a bit faster at 3.00% per year. These are just assumptions. You'd use your own based on your market outlook.
How does projecting it out over 20 years, even with expenses growing slightly faster percentage-wise, change that $510 number?
It changes it quite a bit because while expenses might grow slightly faster percentage-wise, the dollar amount of rent growth might still outpace the dollar amount of expense growth, especially since the debt service payment often stays fixed for the life of the loan.
The mortgage payment doesn't usually inflate.
Right. So in the sample, that cash flow after debt service starts at $510 in year one. But by year 10, the projection shows it growing to $1,017. And by year 20, it's projected at $609.
Okay, that's a much more encouraging picture long term.
It really illustrates why just looking at year one cash-on-cash return, like we discussed earlier from the Reddit thread, might not tell the whole story. If your income can consistently outpace your expense growth and your debt payment is fixed, your actual cash flow can increase substantially over time. It highlights the potential for long-term profitability buildup.
That multi-year view is crucial then, and I think the guide also connected this operating forecast back to the initial purchase budget.
Yes, it ties it all together. That supportable debt amount, $27,424 in the sample, the loan amount the property's NOI can justify, directly feeds into the sources section of the initial development budget or purchase analysis.
So it tells you how much financing you can likely get.
Exactly. If the total cost to buy and maybe renovate the property is, say, $130,772, like in the sample budget, and the pro forma shows it can only support a loan of $27,424 based on its income,
then you know how much cash you need to bring to the table.
Precisely. It tells you the required equity investment needed to make the deal work. It connects the ongoing operational analysis right back to your initial investment calculation. It's all interconnected.
It really is a holistic picture. Seeing it laid out in a pro forma like that makes these abstract concepts much more tangible.
It does. It forces you to put numbers to the assumptions and see how they play out.
Okay, so as we wrap up, let's look ahead. What are the key future trends from that baseline report that rental property owners really need to be thinking about, factoring into their analysis and strategy moving forward?
Several big trends emerged. One is shifting tenant demographics and preferences. Millennials and Gen Z are a huge part of the renter pool now.
And they want different things.
Often, yes. There's a higher demand for tech integration. Reliable high-speed internet is non-negotiable. Smart home features are increasingly expected. In multifamily, shared amenities like co-working spaces or social lounges can be a draw. Owners need to consider adapting their properties or offerings to stay competitive for these renters.
Sustainability came up too.
Yes, that's a growing emphasis. More interest in energy-efficient features, solar panels, better appliances, good insulation. Some tenants are explicitly looking for green features and might even pay a bit more. Builders are responding, and as we mentioned, there can be tax incentives for making these kinds of upgrades. It impacts CapEx decisions and potentially OpEx savings down the line.
What about financing? Any trends there?
The experts' baseline survey anticipate mortgage rates for investors might ease somewhat in 2025, which could help acquisition costs or refinancing opportunities. There's also growth in specific green financing programs designed to help fund those sustainable upgrades we just talked about. More financing options could also potentially encourage new development, which might eventually ease inventory shortages in some markets.
And market competition isn't going away, it sounds like.
No, it seems likely to remain high. Demand for rentals is expected to stay strong, partly because high home prices and interest rates are keeping many potential buyers in the rental market longer.
So good demand for landlords.
Good demand, yes. But as Baseline points out, the operating environment is also getting more complex. Those increasing tenant protection laws, evolving financial regulations, navigating it all requires more sophistication.
So what's the key to success in this evolving landscape?
Adaptability seems crucial. The Baseline report, really underscores that leveraging technology for better insights from data, for finding cost efficiencies, for saving time on admin, is becoming increasingly vital for thriving, not just surviving, in this dynamic rental market.
Okay, that's a great look ahead. Let's try to distill everything we've covered into some key takeaways from this deep dive.
Sounds good. I think the most fundamental takeaway is simply that cash flow is king. It's the bottom line. As Ledger Labs put it, it's the key indicator of whether your rental property is truly profitable and financially healthy long term.
And getting those numbers right, both upfront and on an ongoing basis, is absolutely paramount.
Absolutely. Accurate forecasting using those key metrics we discussed, NOI, cap rate for comparison, cash on cash for your return, DSCR for financing, it's vital for making informed decisions at every stage as data semantics and maximizing rental property cash flow stressed.
You also have to really understand and actively manage all those factors pulling the levers.
Yes. Keeping your finger on the pulse of market trends, especially those local and regional variations. Actively managing operating costs, which we saw are rising significantly according to Baselane. Realistically accounting for vacancy, planning and saving for CapEx. And navigating those complex regulations, all of that directly impacts your cash flow and requires constant vigilance.
Avoiding those common forecasting mistakes seems like basic blocking and tackling, but getting them wrong can be fatal.
It can. Data semantics laid them out clearly. Don't overestimate your income. Don't underestimate your expenses. Don't ignore vacancy and turnover costs. And always, always budget for future capital expenditures. Avoiding those pitfalls is crucial for financial stability.
But it's not just about avoiding disaster. It's about actively improving performance.
Right. You need to implement strategies, find ways to boost income where possible, find efficiencies to reduce expenses, as Ledger Labs and Maximizing Rental Property Cash Flow advised, and support all of that with regular, consistent cash flow analysis to see what's working and what's not.
And don't be afraid to use the tools and help available.
Exactly. Technology and professional help accountants, property managers, can significantly streamline your operations, give you better financial insights, and help you navigate the increasing complexity more effectively. That came through clearly from Baselane and APM.
And the market itself isn't standing still.
Definitely not. It's constantly evolving. Tenant preferences change. Sustainability becomes more important. Regulations shift. Financing options fluctuate. Landlords need to be proactive, adaptable, and ready to adjust their strategies to succeed long term. That was a big theme in the Baselane outlook.
So if you had to give one final piece of advice on analyzing rental property cash flow,
I'd say master the numbers, stay vigilant, and analyze consistently. It's not just about doing a spreadsheet when you buy. It's about continuously tracking your actual income and expenses, comparing them to your projections, understanding the variances, and letting that data guide your decisions month after month, year after year. That's the path to keeping your money flowing in the right direction and building real sustainable profit in this business.
that was incredibly thorough, a true deep dive into the financial core of rental property investing. Thank you so much for walking us through all these sources and making it so clear and practical.
My pleasure. It's definitely a complex area, but getting a solid grip on these financial principles, backed by good data and regular analysis, really is the foundation for making smart investment choices.
Absolutely. And maybe here's a final thought for everyone listening, building on everything we've discussed about this really dynamic market we're in. In an environment where rents might be up, but operating costs are truly soaring, and the regulatory landscape keeps shifting under our feet. Perhaps the biggest financial risk isn't just getting your initial analysis slightly wrong. Perhaps the bigger mistake is failing to continuously monitor what your cash flow is telling you, failing to adapt your strategy, and failing to act based on those real-time numbers over the long haul. What's one thing you will do differently with your cash flow analysis moving forward?